Thank you for joining us for our Seaspray Making Waves podcast series, brought to you by Seaspray Financial Services Limited and Seaspray Private Limited. Seaspray Financial Services Limited and Seaspray Private Limited, trading as Seaspray Private, are regulated by the Central Bank of Ireland. This is Seaspray Making Waves podcast.
Hello and welcome back to episode 3 of the Seaspray Making Waves podcast series. Today we'll look back at the first 6 months of 2023 and examine the outlook for the rest of the year. The Making Waves podcast series is available on Spotify, Apple and YouTube platforms, and you can check us out on our website. Today's episode is also based on Seaspray's half-year investment review and outlook, which is now available for download on the website as well. So, 2023, some of the issues are still lingering that we were concerned about at the beginning of the year. Inflation, looming recession, rate hikes, and the geopolitical instability in the Ukraine. Having said that, no one has a crystal ball, but to help me examine and make sense of some of the recent events, I'm joined today by our 2 regular contributors, Paul McGowan, Seaspray Financial. Hi, Paul. And Danny O'Leary from Seaspray Private. Welcome, guys.
Morning, Marty. Morning.
So, first things first, guys. If we go back to our inaugural podcast in January, I think much of our discussion then still resonates now today. And I think our scorecard will be quite positive in that regard. So, Danny, could I ask you to give us a quick reminder of some of the highlights and key considerations and some of the macroeconomic and market-related calls that we made back in January? And I know you want to include your beloved Newcastle's qualification for the Champions League, but that doesn't count, I'm afraid. Yeah.
We'll take it, Marty. Absolutely. It's quite amazing to be here in July. It's just flown. I don't know about anybody else, but it's going very, very fast. And since our last update, we were talking the banking crisis, and people might say, what banking crisis? So there's a lot happened in the half year that we've just had. Back to the scorecard. We did state at the very outturn that we were going to be looking at risk on in 2023. We probably felt that it was going to come more to the half year, and take a bit of time. The market has been surprisingly positive. And if we take back to last September, October, when we were really looking at the lows, with inflation, Ukraine, etc., we've had a bull market in terms of the US and Europe, with market performances being over 20%.
Right.
And I think that's probably taken us by surprise, positively. And I think there's a sort of a view that we can build on that towards the second half. But I'll go into maybe more of that in more detail. But from the scorecard, I think we were on that risk on will be there during 2023 in terms of the equity market on that side. I think it's been driven by very tight technology sector, 7 mega cap companies out there, but I'm seeing a little bit more of the broader market coming through as well. So, and again, I'll highlight some of those later on. Right. On the geopolitical side, Marty, even last week, we saw in the news 500 days since the invasion of Russia into Ukraine. That's not going away. And, the geopolitical risks are still out there, very relevant. But I think the market is moving through that. And I think the focus that you and I are saying, and Paul will allude to it, is rates, monetary policy. These are all the key sort of scenarios we're looking at. But the geopolitical scenario, and I know even today they're in the NATO and all the meetings going on in terms of where that's taking. But I do think there will be a resolution, but I think it's still going to be some way away in terms of the geopolitical side of it.
Yeah, I think as well, like as Danny has just said, the markets outperformed what we were expecting, and against a backdrop where interest rates have been going up. And inflation was very high at the start of the year. It has started to come down. But in terms of the scorecard, we had expected a view that interest rates in the US would top out around 5.25. We thought the UK would top out around 4.5, and that Europe would be about 3.25. In reality, We're now at 5.25 US. Europe, UK is at 5, and Europe is now at 3.5. And all of the central banks have indicated they're going to go higher because core inflation has held up higher than expected. So we're in this very unusual situation whereby the inflation continues to be high, interest rates have gone right up, and yet equity markets have outperformed in that first period. So this is something that's very, very difficult to try and understand and try and get to the bottom of. One of the suggestions out there is that economies are no longer as interest rate sensitive as in the past. There may not be the same levels of debt in the economies. Businesses are not carrying the same levels of debt as before. So when you jack up interest rates, you're not actually getting the disinflation effect that you're looking for. But we still do believe by the end of the next half, we will start to see that disinflation effect starting to occur, and we will see interest pricing coming under control. And I think by early next year, we're going to see things heading towards the sort of the target 2% that all the central banks are looking for.
In the medium term, there will be some inflationary volatility.
Correct.
Yeah. Okay. There has been a surprising upside for the global equities market, Danny.
Absolutely.
I think what do you perceive to be driving this surprising bull rally, and how would you assess particularly the impact of AI on the tech sector and beyond into other industries, for that matter?
I think the market, particularly during Q1, Q2, they were coming off the lows. Particularly if we look back last September, October, the technology sector was really hit hard, with rising interest rates. And you saw a very strong negative scenario in Q4 last year in terms of that. So a key driver of, I think, the market that we're seeing at the moment has been the fact that the tech AI side has actually moved ahead. And just to give a couple of examples, we've had OpenAI and ChatGPT hitting the market and the news with millions of followers, and you've now got, in the last week, we have Threads. I had never heard of Threads until a week ago, and now it's one of the major competitors to Elon Musk's Twitter.
Right.
They have 100 million individual users of Threads within 5 days. Now, this is the speed at which I'm seeing things happening in the technology sector, and it's just to give that example. That's on the communications side.
Yeah.
The same with the major tech companies as well. We now have Apple. I was talking about this in our last podcast in terms of the metaverse and where I see that. You now have Apple in that sphere, and you have the headset, the avatars that they're bringing out to the market. So you do have a lot of things happening in the tech sort of AI space. So I think what's been leading it has been definitely that. And when I look back at the sectors over the last, global equities are up about 11.4% for the half year. When you look at the mix of the sectors that it's coming from, tech is up about 33%. You've got consumer discretionary up about 22%, and the communications in around the 22%. They are the key drivers that have been happening in the first half of the year. If I look at some of the other sectors, industrials are up around about 9%, but healthcare is down 3%. Energy down 7%. And commodities, they're likewise in the negative. So when you look at it, it's been a mixed basket in terms of performance that we've seen in terms of the first half. But I think it's been very much tech-driven and also AI-driven. And even this morning, just before coming on the podcast, we've had this debate over the last number of weeks about the good and the bad of AI. And I think we've got to get a balance here. If I look back through history and I look back at all of the industrial revolutions way back, and I look at the mass production era, Model T Fords, and I look at the digital revolution that we've had in terms of the 30 years ago, every time technology is coming to the fore, people are looking at what are the threats, but you've got to look at the opportunities as well. And my view here is that, yes, there's going to be concerns about what will ChatGPT do to us in terms of our ability to write and our ability to have proper education. But even this morning, all of the universities in the UK, 24 of them, have embraced AI in terms of the education system for third-level colleges, and putting procedures and putting ethics in place. And I think that's the way we need to be looking at this in terms of trying to embrace it over the next number of years. And I think that's been seen in terms of the performance year to date. So it's been driven by what I call the mega cap stocks, but I think there's a wider market coming through in terms of the actual performance, and those sectors will highlight that.
Yeah, and there's some significant statements about AI being made by key players like Goldman Sachs, for example.
Absolutely. Certainly, I think when I looked at the Goldman Sachs report, there could be sort of 300 million over the next number of years displaced, or, looking at what's going to happen to my job.
Yeah.
But if I take the other side of that, it's going to add at least 7 trillion to global economic production over the next 10, 20 years. It's huge, it's significant. And with that comes employment. It comes new jobs. If we go back to our own Irish situation here over the last 50 years, we didn't have Google, we didn't have Meta, we didn't have Microsofts, and we didn't have the Apples. And look at the employment that has been in jobs that didn't exist. We're going to have millennials in employment doing things that I don't even know about at the moment.
Yeah.
So I think we've got to look at both sides of that to actually really get a grasp that AI and the technology developments that are coming with us now are going to be significant over the next number of years. If I could give 2 examples,
please,
very briefly. Last week, there was people who were of hard hearing and deaf, and they put on a pair of these special glasses. They're XR glasses. I won't go into it, but it's an app. And that app is built into the glasses. And it produces subtitles as I speak. So on the other side, the person can actually know what I'm saying. And I just think that's amazing. And not alone that, they are able to take a group of people with different accents and my accent and whatever else, and take that and actually interpret that so you can have group conversations.
That's amazing.
That's a benefit of AI.
Yeah. Simple benefit, but amazing.
And it's amazing. So again, I'll come back to that. And the one thing I do want to say, and I'm not in the agri sector myself, but there is now a herbicide and sort of vehicle that is there with an ability to actually kill weeds in the field without chemicals. And I've seen this in production. What happens is you actually have a tractor pulling this unit, no more than like the combine harvesters or whatever, but this unit has very strong laser coming from it, has a supercomputer. And what happens is that in real time, it actually goes over the land, and the lasers kill the weeds and leave the crops intact. And to see it in production is just incredible. But what happens is you now have higher crop yield, you have the weeds and everything else being destroyed, 99% of them destroyed, and no pesticides, no chemicals in there. It kills 200,000 weeds in 1 hour.
Wow. That's a real example of AI in practice.
This is AI in practice. So when you multiply that out in terms of what benefits it could have from the agricultural sector and from a climate and sustainability, I am very positive about the AI influence over the coming decade.
Most definitely. I think that's quite obvious. And then that's in a very macro sense. But I think it would be appropriate for us to bring the conversation back to our own domestic economy. Our Irish corporate tax receipts are booming. The CSO are reporting full employment. We had more people working since the inception of the state. So
it's actually incredible. It's been such a good success story. There are people on the left who might like to talk negative about it, but the reality is the numbers speak for themselves. We're looking this year. Last year, the economy grew by 8.2%. This year, they're talking about 3.7%, the modified economy, which is the domestic economy. There have been some shifts shifts at the GDP level, which is combining the multinational and the domestic. The numbers are coming out much lower in the GDP figure, but that's for a reason. There's been a fall off. We mentioned it at the beginning of the last podcast. The pharmaceutical exports to the US have dropped by about 27%. But that's because the previous year, we had the big exports on the back of COVID. So there's a normalization on the pharmaceutical side happening. I think this is a blip that we're just seeing in the GDP numbers. And I think by the end of the year, that blip will have ironed out and you'll actually see the overall GDP numbers will be very strong by the end of the year.
Yes.
But stripping that out, the actual domestic economy growing at 3.7% is really strong. When you compare against Europe, where growth is around 0.8, 0.9%. So Ireland Inc. itself, and domestic Ireland, is growing extremely strongly. The tax receipts are coming in far higher than have been expected. We're over 6 billion in the most recent numbers, above expectations. Looking like by November we'll have revenue in around 40 billion, and it's leaving the Irish government with an issue as to how much should we save, how much should we spend. Now we have a budget coming up, so there's going to be extra amounts given out in this budget. Yeah. What they have been doing, though, which I think is very positive, is they keep putting money away into the rainy day fund. So 4 billion was just put aside in the last month into the rainy day fund, which helped. The net surplus was showing, it came out at about 2.2 billion. But in fact, when you add back the 4 billion, it came in at over 6 billion, which was slightly ahead of the previous quarter. So we're continuing to grow. We've strong tax receipts. Income tax receipts are really strong. Corporation tax receipts are really strong. And then we have the other great thing, which is we're at full employment. We're at 3.8% unemployment rate. There's always going to be a small element of unemployed in the country that you will never get down below. This level we're at is full employment. And that's against the backdrop that the population has grown. The net immigration has been over 500,000 people in the last eight years. So you've got full employment on a higher number in the domestic economy. It's a very attractive backdrop. It's actually a great success in many ways. The big negative is the talk about housing, but that's complicated on three different levels. One, we've had a massive amount of new people coming into the country. Two, we had a situation where for nearly 8 years we did no construction. And then three, we have really strong planning laws. And so they're having to overhaul those laws. And that has slowed down the level of construction. But I think it's quite noticeable in the last 6 months. You can see around the country, there's construction happening everywhere. Apartment blocks are coming out of the ground. Housing estates are appearing. Now, this has to go at an even faster pace. One of the issues for it is lending and getting the balance right in terms of, at the end of the day, the developers have to make a profit. And it's trying to get the pricing in terms of the construction costs versus the sale price right. And that is still an issue within, and that goes back to the whole inflationary environment. Yeah. As inflation eases off, then that environment may get easier.
I think we're
for
seeing that actually with some of the raw materials, even in the last 3 months.
That's true.
Costs have come down, and I think you actually are seeing that. And certainly anecdotally, as I travel around, I'm seeing those completions coming on stream. There's no doubt
more
about
developments
that.
for sure.
Absolutely.
Yeah. I mean, it's a really good story for Ireland. And as you said, Paul, there's a balancing act for the government, I think, to address cost of living and not stoking the inflationary numbers too much, So I think
it is a real issue. This is, how do you do it? Like there is a counter argument that in fact, if interest rates are not working in terms of cutting inflation, that actually you should use fiscal policy, which would actually suggest increasing tax rates to try and cut off the growth. I don't think that's going to happen. There's not a chance of it. So we are probably going to see that inflation is going to be with us for a lot longer. And I think we have to get back to a norm that we're going to exist for quite a while with these higher interest rates. Yeah. And the economy will have to adjust to that. Yeah,
no, that's fair. If I could just move on to, if we look at portfolio investment specifically, and where would you see, Paul, the key stocks are, in terms of putting some of those on a watch list, if it was?
Well, it's if we're talking on a domestic basis,
Yeah.
I suppose previously we weren't big fans of banks, but an interesting thing happens when you get inflation and you get interest rate rises. The net interest margin for banks expands. That's where the difference between what level they're taking money in on deposit at and what level they're lending out at. At the moment, the likes of AIB, their net interest margin has gone out to 278 basis points. So this is up 60 basis points on what they would have been at a quarter before. This is resulting in a massive increase in profitability. The exact same is occurring in Bank of Ireland, although they haven't released their actual net interest margin figure. What we are seeing now is a situation that the balance sheets of the banks have been completely rebuilt. The central bank and the ECB set down really strong tier 1, tier 2 requirements. And so that the balance sheets are now almost with capital levels double of what they would have been, let's take back at the great financial crisis, if not even a little bit higher. And they're still now making strong profits. So we would definitely have AIB and Bank of Ireland on our buy lists at the moment. Okay. We would have price targets probably about 30 to 40% up from where they currently are. So any day there's dips, we'd be looking to buy into them and add to portfolios, but only on a balanced basis. At the beginning of the year, we talked about Ryanair as a stock we liked. We continue to like Ryanair. Their most recent numbers have come out showing really strong capacity. Their 95% load factor, carrying 16.4 million last month, on target to just over 50 million in the quarter, looking like they're on target, but to continue to grow. Their own target is to hit about 255 million passengers by 2025. I think they could hit that before then. We had a target. At the beginning of the year, Ryanair were around the 12, 13 euros. They're currently 16.70, 16.80. We have a price target of 20 euros. We would continue to recommend holding on to them and buying in at these levels. Then the other one obviously was CRH, very big Irish story. We had a situation where at the beginning of the year, we had a CRH on our buy list. We had a target price of 50 euros. It's hit the 50 euros in the last couple of weeks. It also has gone through a process where they're now delisting from the Irish Stock Exchange. And their whole focus is going to be on the US market.
Okay.
Over 58% of their current business is in the US. So it is the right place for CRH to go. It's a negative for the Irish stock market in that we've lost our biggest component. And it will kind of contribute to a marginalization of the actual stock exchange. But as a house, we don't care, to be honest. We deal in all investment markets. We can access all stock markets. So we just look at we're looking for the best assets. Now, Danny has referred to AI and to technology. Technology is going to continue to grow. Yeah. So in our core portfolios, we have to include the big cap companies because they are continuing to perform. The involvement that most of the big companies now getting into AI means that this is like being back at the start of the internet. And the growth, like you'll remember when the company Amazon came on the market, and what were they doing? They were a bookseller. And who would have thought they would ended up being the sort of size of retailer they are globally? The impact of AI that Microsoft have, that Apple is now integrating it, that Alphabet have, this is going to continue to grow those companies. So they have to be included in any core portfolio as well in what you're doing.
Okay, great, excellent. That's super insight, Paul. Thank you.
And it's interesting also on the tech side, NVIDIA's results came out and they've really outperformed. They've been the outlier in terms of performance in the first half. But even they clearly stated that the market is not taking into account that they expect sales to be 50% higher over the coming 12 months. Predominantly because of the AI and the chips required for the AI sort of market that's out there. So I do think in terms of part of that portfolio, whether it's on an individual basis or through other solutions that we got, these are all on the table in terms of where do we see returns coming over the next number of years.
That was NVIDIA you said, Danny, wasn't it?
NVIDIA, yeah, exactly.
Okay, yeah. And aside from investing in the stocks we've just analysed, there's an argument, Danny, for investors looking at a structured solution. I know the house has some experience in that. And what are the key growth investment themes which we should watch out for?
Certainly. We've probably created about 6 solutions since the start of the year, I think, Paul, in terms of for our clients. And the themes at the very start of the year were very much on the technology side. It was a beaten up sector, last September, October. So we saw entry levels there. That technology, I keep saying this, is not going away. So again, we had a technology structured solution, and we were able to price at those levels because of volatility, and they were beaten up. So you're getting double-digit potential returns on that as a structured solution with conditional capital protection. So it fits a risk-adjusted portfolio, and it comes as part of any direct shareholding and bond holding as part of the overall asset allocation. We've also looked another key theme for us was water and the oceans,
yes,
and conservation and preservation. So we actually had a transatlantic, water bond, very strong in terms of diverse nature of companies in there, but their total focus was on water preservation, conservation, and protecting the environment. But these are companies which are major companies that are across the globe, but they're doing the right thing, and they will be rewarded, I believe, as a result of that. And that was another theme that we would have looked at. The AI theme, of course, Marty, we're very much in terms of the theme, and looking at some of the companies that we've just mentioned, the Microsofts, the Apples, because we believe that those are the type of companies that are at the cutting edge, and they can use their revenues, and they can use their strength, and they can use their balance sheets to be able to fail and also succeed in the opportunities within the AI sector. You don't have to go to the extremes where you're taking companies that tomorrow morning could be gone. These are the companies, I think, that will have the staying power to make sure that we can actually benefit from the investment, but also benefit from the technology and the AI going forward.
Certainly adds that well-balanced portfolio point that we've been addressing. Yeah,
totally.
So if we look ahead and take our crystal ball out into the second half of the year and beyond, Paul, where's the value for investors there, and how do you see the outlook?
Well, I think it's very interesting. If you go back 2 or 3 years ago, we took a decision that bond markets were not a place to be, and so we repositioned our portfolios away from it. Now things have changed. With the higher interest rate environment, we have to take account of the opportunities in the bond market. So definitely short and medium term bond investment is part of any portfolio structuring we're going to do now for this next 6 months.
Right.
And we will be including that on weightings within our portfolios. At the same time, there is still potential in markets. Like, for example, the European market, the MSCI, is only trading at about 12.5 times, when at long run it's usually up at around 15 times. So that's exposing value in markets. The UK market is starting to look very good value at the moment as well. However, you have to be cautious with the UK. There are a range of negative issues on the sidelines, so there's a timing thing on it. The UK market does contain a lot of global companies, so that kind of counteracts what's going to happen domestically. But we will be selective in our acquisitions in the UK, but there are some opportunities opening there. And the negative, like on the horizon for the UK point of view, you've just had a situation where there's a massive unwinding about to begin of fixed rate mortgages. So 2 to 3 years ago, there was a huge number of 2 to 3 year fixed rate mortgages taken out. Those are all unraveling from July this year. And you're going to have a lot of people in the UK going from 1% to nearly 5-6% on their mortgages. And the strength of inflation in the UK economy means the Bank of England is going to have to keep pushing interest rates higher. So cautiously entering that market, but there is value there.
Right.
I think it's a mix between doing as Danny was saying there, it's investing for the long term. So finding the sectors in the country and in the areas that we think will be the long term gains, while counterbalancing your portfolio with some bond investment, which will also help mirror the impact of what inflation is going to do within portfolios.
I think you've got a balance now that we didn't have last year. Last year, bonds and equities were down. And now you've that ability at current levels. I'm seeing international banks, European banks, for example, producing deposit rates of 3.5%, and you can do that over 1, 2, or 3 years. And I think in terms of the shorter term end of the market, you've got government bond yields, again, around that 3 to 4%. When you stretch that out over 10 years, US 10-year yields are about 4. I think our own Irish yields are about 3. So let me just highlight. I think inflation is going to be higher for longer. So let's just step back. They are now positive. But as part of an overall portfolio, I would be using them as a defense mechanism for liquidity over the next 1 to 3 years. I wouldn't be going further out. I'm taking on more risk. But if I can get a 3 to 4% for part of my portfolio when it was negative last year, so if I take a multi-asset fund, naturally, if I have 25% held in bonds, I'm going to be comfortable now I can add some value to that overall portfolio, okay? But in real terms, if I'm looking at inflation over the next number of years, I believe, as Paul said, I think a range for the central banks will be 2 to 4%. It's not going to be 0. It's going to be in that 2 to 4. So let's just say it's a 2.5% average in terms of that. If I'm getting 3% on my money, my real return is not going to keep pace over the next number of years. So yes, the bonds are very strong and the short-term deposits are very strong. But if clients are asking me, well, what about the medium to long term? Where do I see value? Just to come back to it, equities, I believe, will deliver over that longer term. Real assets in terms of property and equities. And I know the property market has been hit as well. But from an equity positioning, if I just take a bit of history here in terms of equities and inflation, when you're looking at the biggest market in the world, the S&P 500, what I'm really looking at is there, if I take, it's like a bell curve. I can't just put the illustration there, but it's like a bell curve. So you've got peak to trough in terms of these cycles, in terms of inflation. And when you take the inflation that we are now, a current cycle, it probably peaked in the US at over 9% 12 months ago, 15 months ago at this stage. And when you look at the trajectory moving downward, we're now down in US inflation at 4%.
Correct.
And the trajectory from, if I go back over maybe 4 or 5 episodes of the similar inflationary cycles, that is telling me that over the next 12 to 18 months, the US inflation should be coming back down to 2%-ish. So let's say that we're in that 2 to 3% scenario. Then if we look at and overlay the S&P 500 in terms of 10 or 12 episodes as we go through the last 1950 right up to 2018, the bottom of the market has probably happened about 15 to 20 weeks after the peak of inflation. The bottom.
Okay.
If we look at the current cycle, that happened last September and October.
Yeah.
Now, when I extrapolate that out, the market, the S&P, over the next 2 years has actually delivered strong returns post coming out of that cycle. So I would probably be of the view that if we're looking for return, we're still in the camp where naturally we have to have the defense and we have to have the bonds to supplement that. But if I'm looking to get real return above inflation, I do believe the equity story is the place to be.
Excellent.
And well diversified.
Yeah. I think that data insight that you're referring to, I think it's available on our website.
It's actually on our website.
Yeah, it is,
I can't draw the graphs, but it's on our website.
You can see it on our website. That's cool.
Yeah.
So just to wrap up, as is our want, we like to ask our clients, do they have any concerns or any questions? So we have a couple here. So I've got one each for you. Paul, I know you've referred to it already, but just maybe we can delve into it a little bit more detail. The question here is, what does the CRH delisting mean for the Irish Stock Exchange?
Well, it means that the overall market capitalization of the exchange has gone down. That's the first thing. So when people are looking to allocate funds, we become a smaller percentage of the overall European allocation. That's the first thing,
right,
which is negative in terms of capital market access. Secondly, it suggests to players that the market doesn't have the strength for new raisings. So there's very few new listings coming because new listings will be thinking, oh, this is a very small market. Don't know if I'm going to be able to raise money on it. Maybe I should go elsewhere. That's not good for Ireland Capital Markets Inc. because we should always have a platform in which companies are encouraged over their life cycle to go to the market to raise capital. And there has been obviously an awful lot of private equity money in the market. But for the longer term and the health of our overall capital markets, it is good to have a strong stock exchange. And this is a negative. And the concern is that other companies are going to follow CRH. Now, we did have the move of companies going to the UK, but with Brexit and everything else, that kind of unraveled, and a number of them came back. But the longer term scenario is very concerning, that this is, other companies will make the move to the American market as they've expanded. Now, it is a real positive for Ireland Inc. that we have corporations that have big operations in the States and vice versa. But as our capital market side, really we should have a much stronger and more vibrant marketplace. Like when you compare against the likes of Israel, they have a really strong stock exchange that there's a huge amount of new issues and the like. We don't have that in the Irish market. And it is a question that has to be raised for the longer term.
Great. Okay. Thanks, Paul. That's an excellent answer. Danny, there's a question on bond yields here and bonds versus equities. So it's with bond yields surging in the last while, is there an opportunity for investors to generate a reasonable return on bonds with lower risk rather than equities with higher risk for returns?
It's coming back to, my mantra. I think bonds as a defence are very, very important. And clients, as part of their overall portfolio, they will need to try and have a sort of 1, 2 or 3 year time horizon, whether that's a deposit or a bond that can provide that. You're taking on less risk, certainly in terms of that. I just come back to what are your goals and objectives? If overall we're looking to try and capture return, it will not come from a real return from bonds. It'll help support, but it won't come from driving return over the next number of years. So my view is part of an overall asset allocation, yes, it should be there. You need that liquidity. And compared to the last decade when we were negative rates and bond yields weren't giving anything in terms of any type of return, to be able to capture that in the speed that we've now gone in 12 months with the rate rises, I think it is important that it is part of anyone's portfolio to capture that. However, the real word here is return. Return to me will come from the real assets. That'll be your capital and dividend that you're going to get from any equity holding that we can actually put in place, be it by structured solutions or direct equity exposure into the markets. I do believe that's where the real return will come.
Brilliant. Okay, great. Well, that was a quick half hour. The time has flown. That's super stuff, guys. Thank you very much again for continuing to make waves.
Absolutely.
And no doubt our investor clients will derive some benefit from this, no doubt. If you want some more detail on our discussion today, I can refer you to the Seaspray half-year investment review and outlook for 2023, which is available now to download from our website. This episode is available on Spotify, Apple, and YouTube platforms. We hope you enjoyed the discussion, and we'll see you next time, and bye for now.
The preceding content is informational only and based on information available when created. It is not an offer or a solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you. Seaspray Private Limited, trading as Seaspray Private, is regulated by the Central Bank of Ireland. Seaspray Financial Services Limited is regulated by the Central Bank of Ireland. Thank you.